Greetings, everyone. We are back with our August market commentary. Today is August 30th. You will likely be watching this video either on September 1st, or if you are checked into Sunday Coffee Reads, September 4th, I believe. So lots to cover. We've got some slides to share. We're going to share about 7. We want to keep our message on point. And this month, it's all about the Fed. So the Fed just wrapped up their annual meeting at Jackson Hole. Lots to talk about. So let's get right to it. I'm going to share my screen. Hopefully my mouse is showing up. And I put the little subtitle, "The Hawks Have Landed." And I'm not talking about the bird. I'm talking about the bias of the Fed. So hawkish means there's a bias towards rates going higher. And it seems as if the Fed caught the market off guard, and while their tone can change from month to month, that seems to be the bias of the Jackson Hole Conference. And what's interesting to me is just last month, just in mid-July, when the Fed released their minutes from their monthly meeting, Fed Chairman Powell used the term neutral. He was proclaiming that their current Fed funds rate was neutral, which confounded a lot of people. And then this month, fast forward just about 30, 45 days later, he's getting more aggressive on inflation with the bias towards higher rates. So it's interesting how inflation data has softened, yet in a span of 45 days, the Fed has decided to get tough. And this is straight out of the late 70s, early 80s playbook, where the Fed decided to drop the hammer and committed to snuffing out inflation through higher rates. I'm not saying that's going to happen this time, but that certainly was the tone out of Jackson Hole. So let's get into it. I'm going to share my screen here. My microphone padding just fell to the floor, so hopefully that doesn't make me sound awful. Okay. Oops. Okay, so here we go. All right. So this is a monitor of Fed tone. Let me move my little guy here so you can see the source. All right. So there's a lot going on here. The important thing to note is when this dark blue line is going up, that means the Fed is hawkish, has a bias towards increasing rates. And what this does, this is kind of a cool index. It basically tracks every Fed governor, Fed Chairman Powell, tracks how they talk. So while there's these official press releases, Jackson Hole, their monthly conference, Fed governors are out in their districts, giving interviews, talking to the press, talking to investors, almost on a weekly basis. And what this does is track the tone of their comments. So this is a proprietary index to our friends at Bespoke, but it does well to track the sentiment, the tone of the Fed. And you can see this light blue line is the 3-month change in the 10-year yield. So these two lines, in theory, should be correlated. And if you track this back to March of 2019, I think they loosely are. There's times when they become a little disjointed. And right now, the Fed's tone is really hawkish. You see that up here, or slightly hawkish. And the 10-year yield is kind of dragging its feet. So it wouldn't surprise me for these two lines to converge. Either the Fed backs off some of their rhetoric and becomes a little more neutral, or the 10-year yield goes a little higher. But the takeaway here is there's a bias towards increasing rates. And I think you got that out of the Jackson Hole speech. So let's talk yield curve inversion. So this goes back to 1977. And what this is showing is the spread between short-term yields, so a two-year note, and this is U.S. Treasuries, and the 10-year yield. So in theory, in a healthy economy, you would see short-term rates lower So short-term rates lower and longer-term rates higher. So in a healthy economy, this spread would be positive. It would be above this zero bound, right? You can see during some of the boom times, like in the 90s, early 2000s, post 2010, this is an upward sloping curve, meaning longer term yields are higher than shorter term yields. During times of economic stress, or when the Fed is trying to snuff out inflation, the yield curve will become inverted, meaning short-term rates are higher than long-term rates. And you can see some of these crazy inversions back in the late 70s and early 80s were really the Fed's doing, aggressively raising short-term rates, trying to slow down growth and economic activity. We're not quite at the level the Fed was back in the late 70s and early 80s, but the Fed is definitely trying to pump the brakes on inflation. Now, the question is, has inflation peaked? Some say yes. There's data to support that. So the worry is the Fed slamming on the brakes in the economy at a time when it's already naturally slowing and inflation has peaked? That's the question. The data is messy. Again, we've said this is not like any other business cycle. The Fed gets a lot of flack, but they have an impossible job. This is a very difficult time, a very confusing time. The data is noisy. It changes from month to month, which is why I think, although they were hawkish in their latest comments, an investor needs to keep an open mind because things can change. And I wrote about this a couple weeks ago where investors had thrown in the towel back in the early 80s, in 1982. It was a nasty bear market. Markets were down by 20-something%. And the Fed pivoted. The Fed went from aggressively hiking rates to actually cutting rates in the third quarter of 1982. Markets screamed higher and finished the year positive. So these are the inflection points that we talk about. And it's really hard to anchor to one narrative or one theme in this environment. In our opinion, an investor would do well to keep an open mind, to change your mind when the facts change, to not anchor to one identity or one narrative, because investing in a complex system, things can change quickly. There's a lot of variables. There's a lot of randomness. So keep an open mind. All right, so there's a lot of talk about where rates are headed next, with what the Fed thinks, what Wall Street thinks. This is what the market thinks about rates. Okay, so there's a lot going on here. The biggest takeaway is this is the market pricing. This is investors voting with their capital where they think rates will be over the next couple years, over the next 3 years. Okay. So these lines, and I don't want you to get caught up in all this, these are just various pictures where the market was projecting rates to be over the next 3 years at various points in time. And you can see this all converges around, I don't know, this neutral rate of 3 to 4% perhaps. It's gone down a little bit. And right now the Fed funds rate is 2.25 to 2.5%. So call it 2.5%. The market is not buying the Fed story. Okay. The market is pricing in the Fed's neutral rate over the next couple years is going to be around 3%, maybe 3.5%, which is only modestly higher from current levels. So although the Fed is talking tough, although there's a lot of folks in Wall Street that think rates are going to go much higher, the market is not buying it. So this is what we talk about when we say taking our cues from the market. I can listen to talking heads, which are probably talking their own book or talking their own positions that would benefit from their forecast, or I can look at how the smartest investors in the world are voting with their capital. I will take the latter every time. So again, the market's not buying the Fed story. The market doesn't buy the fact the Fed's going to raise rates come hell or high water. Again, things can change month to month. A great example of that was something I used at the opening of the video. July, the Fed was saying the rates were neutral. meaning they were probably going to stand pat. August, they're saying, oh, we're going to be much more aggressive on inflation and we're going to raise rates. So let's talk inflation. I know a lot of people want to track the CPI, the Consumer Price Index. That's probably the most popular index, but I can tell you the Fed's preferred index is personal consumption expenditures. So this is basically the Fed's North Star. This is what they're looking at. And this is a measure of prices that people pay in the US for goods or services. Okay, and you can see this is tracking the annualized rate of change over 1 month, 3 month, 6 month, and year over year, which is this lighter gray line. It's kind of hard to see. I don't want you to get caught up in what these lines are doing. Just know that across all of these metrics, inflation is coming down. Prices that people are paying for goods and services are coming down. Okay, we kind of got this head fake back in the middle of 2021. You can see prices were coming down, and then again at the start of 2022. So I don't know if this is the peak, the sign of peak inflation, or this is another pump fake. But this meaningful move down in the 1 month number, so month over month changes in consumer expenditures, has gone down dramatically, and part of this is just the retreat in gas prices, which certainly helps consumers. So this is something to watch. If this line does mark the peak and this line going forward goes down even more, that makes the Fed's job a lot easier. The Fed could have data to support backing off rates going higher. So when people talk about inflation peaking, this is what they're looking at. This is what the Fed is looking at. Again, if this line continues to go down, these other lines continue to go down, that makes the Fed's job a lot easier. They could pause, they could become neutral, and I think the market would like that clarity. Back in my previous commentaries, I outline how changes in Fed policy, uncertainty around Fed policy equals noisy markets, equals stock prices moving like crazy. And that's really what's happening. So that part doesn't surprise me. I think the Fed would really catch a break if there was substantial evidence month over month that confirmed that inflation has indeed peaked. Okay, so don't freak out. There's a lot going on here too. But I think this is a pretty cool dot plot or scatter graph or whatever you call this. So this is the S&P 500 versus various bond indexes over the last 50 years. And this is through the month of August. So going back 50 years through the month of August. And each one of these dots represents a year, represents a calendar year. And in the left axis here, this is the S&P 500, right? So if we were to track this, this would be positive S&P returns. This would be negative. So this is the same across each one of these graphs, right? We're tracking the S&P versus various bond indexes. So the bond indexes on the x-axis do change. So this is the aggregate bond index, government bond index, investment grade corporate bonds, and lower quality corporate bonds. But again, the y-axis, the S&P does not change. And what we're trying to track is how awful 2022 is. 2022 is an extreme outlier. And it's very rare for stocks and bonds to move down together, but that's what can happen when inflation and interest rates are going higher. And you can see in this bottom left quadrant across the various types of bond indexes, almost universally is negative for these high inflation years. And not only high inflation years, but years where the Fed is increasing rates to try to snuff out inflation. So you can see 81, 73, 74. Same thing down here, 81, 74, 81, 74. And 2022 was the worst of them all. So let's just look at a few of these. So the S&P, as of this recording, is down roughly 14, 15%. So this line would actually be a little lower. And you can see bonds are down about 11 or 12%. So this is the aggregate bond index. All right. Notice how far away 2022 is from the rest of these dots. Same thing for government bonds. Government bonds have done a little bit better, down about 10%. The S&P, again, it's not going to change, down about 14%. But look how far away 2022 is from the rest of these dots. And the theme continues. So this is a historically bad year. In a year like this, everybody is going to feel pain. Our focus is on mitigating damage. We've said that across our blogs and our podcasts and in these videos. Everybody is going to be uncomfortable in this environment. This is unlike any market and business cycle over the past 70 plus years, past 80 years. It's very rare for stocks and bonds and most every asset class to be down together. Our focus is mitigating damage. I can't stress that enough. Okay. So the dollar is strong. And I know I'm kind of bouncing around here, but the dollar is strong. And what we're trying to track with this graph is from the dollar cycle low. So January 2021, the dollar hit its cycle low. We're tracking from that cycle low through last Friday. Okay, so roughly, I don't know, what is that? A year and a half of data, a little more than a year and a half of data. And what we're trying to track here is looking at the universe of the Russell 1000, which is a pretty good snapshot of the US stock market. How have the companies with most of their revenue being derived in the US done versus companies where a good chunk of their revenue is derived in foreign markets done? So countries that do business mainly in the US that derive a majority of their sales in the US versus companies that are more global, that derive a good chunk of their revenue outside the US. Okay. So the companies that derive most of their revenue in the US are in decile 9 and 10. Okay. And you can see companies that derive most of their revenue in the US have done the best. Companies that derive most of their revenue globally have done the worst. And a lot of that has to do with the strong dollar. Okay. So let's start with companies that derive most of their revenue globally, right? If you generate half of your sales in Europe and the euro is weaker relative to the dollar, right? So your currency, like you're selling things in euros and you have to translate those euros back into dollars. It takes more euros to buy $1, let's say. That's going to hurt your bottom line, right? When you translate those euros back into dollars, since the dollar's strong and the euro's weak, that's going to hurt your top line. It's going to hurt your bottom line. Thus, your stock price is going to suffer. Okay. So the companies, oops, that's not what I wanted to do. So the companies that are more global historically are tech and materials. Larger companies are going to fare less well when the dollar is strong. Conversely, let's say this trend flips and the dollar gets weaker and the euro gets stronger. That's going to be a tailwind for these companies that do business abroad, because you're going to have stronger euros and a weaker dollar. That euro is going to buy more dollars and translate into more sales and a better bottom line. But that's not the case right now. And then the companies that are dealing in dollars, they've done well. The dollar's strong. They don't have exposure to global currencies, which are generally weaker. Those stock prices have benefited in 2022. So that's an interesting factor. And usually it's really hard to make investment decisions based on currencies, the strength of currencies, the weakness of currencies. The currency markets have a lot of randomness, and a lot of them have to do with global trade, interest rates, central bank policy, which is all impossible to predict. So this is just an interesting kind of hindsight factor, given what the dollar has done so far this year. Credit spreads. So this is one of our favorite metrics, and I think this correlates nicely with equity markets. And again, I'm a fan of looking at credit markets because I think that's the smart money, much more rational than equity markets. And what this basically is, this tracks the borrowing costs of lower quality companies, right? So fringe companies, marginal companies. And when this line is going up, that basically signals stress and or rising borrowing costs for lower quality companies. When this line is going down, that might signal a risk on attitude, a lower cost of capital for lower quality companies. And what we found is when this line is going down, stocks tend to go up, right? And I think you kind of see this nicely from the low in June. So the S&P hit its low in about mid-June. That marked the peak, at least so far in this cycle, and peak in credit spreads, the low in equity prices. And as these credit spreads started to tighten, as the cost of capital started to go down for lower quality companies, you saw the equity markets rally. Okay, that's not uncommon. All right. As we've got this latest hiccup at the end of last week and so far this week, you see credit spreads have started to tick higher. Equity markets are down. So this is something that we watch very closely. Historically, peaks in credit spreads, which are impossible to call, but historically, looking back, peaks in credit spreads are a good time to invest. That historically has marked potential market bottoms. But again, there's a lot to play out here. The Fed's still in the middle of their, do we hike, do we not hike? But this is something that we watch very closely, and this has been very correlated, inversely correlated to equities. So as these spreads go down, equities tend to go up. As these spreads go up and borrowing costs go up, equity prices tend to go down. So I hope you enjoyed this. This was Fed heavy. This just gives you insight into some of the things that we're watching. I think an overarching theme is taking your cues from the market. There's a lot of talking heads on TV, on social media, which, those folks can say whatever they want. Professional investors watch the signals the markets are giving, and I hope this gives you some insight into some of the things that we're watching. Of course, we don't make predictions. As I ended on my last post, an investor would do well to keep an open mind, to be flexible, to change your mind. Don't anchor to one narrative. This is a very confusing and difficult market environment. I think that showed in our dot plot graph, where 2022 is an outlier in many respects. If you have any questions about what I've shown you, about how Pure works with clients, about how we build portfolios, about how we manage risk, feel free to shoot us a note at insight@pureportfolios.com. Thanks for watching. See you next time.